me. So welcome to Lecture 6, Investment Banking. And investment banks are financial service institutions that underwrite, issue, and distribute securities. So here is the structure of this lecture, and we will go through these topics very quickly. The first topic is the background of investment banking. Investment banks, in a word, are an intermediary for companies that need capital to finance their investment and expansion opportunities. Investment banks bridge these companies to investors who have excess cash. Compared to the scenario in which companies issue and distribute shares by themselves, companies would like to employ the service of investment banks because this will reduce the total transaction cost for the issuing company. And in addition, investment banks are an outsider to the issuing company. So investment banks also have some responsibilities for verifying the documents and financial accounts of the companies issuing shares. So investors would be more likely to trust the information verified by a reputable investment bank than the information provided by the issuing company itself. So that means the presence of investment banks will reduce the information asymmetry between investors and the issuing company. So if you have any question, you could stop me or type your question in the chat box. So here is a short background of the investment banking industry. In the United States, since the Great Depression in 1930s, investment banks had been separated from commercial banking. What is commercial banking? Commercial banking is the activity of deposit taking and commercial lending, such as bank loans, credit cards, and mortgages. A reason for separating the two banking sectors was that the high risk level of investment banks would put the entire commercial banking sector at risk. So by separating the two banking sectors, commercial banks were prohibited from using depositors' funds for making risky investments. So that will reduce the total risk level of the entire banking industry, including both the commercial banking industry and the investment banking industry. And in 1999, the Financial Services Modernization Act partially deregulated the financial industry. So commercial banks, investment banks, and also securities companies and insurance companies were allowed to consolidate. So the justification was that individuals usually put more money into investments when the economy is doing well, but they put most of their money into savings accounts when the economy turns bad. So with the passage of this act, investors would be able to do both savings and investment at the same financial institution, So the institution would be able to perform well in both good and bad economic times. Then in the recent global financial crisis in 2008 to 2009, quite a few investment banks collapsed. But that didn't change the trend of the integration of commercial banking and investment banking sectors. Okay. And the key functions of investment banks. Investment banks have the following key functions: underwriting stocks and bonds. So investment banks not only underwrite stocks, but also underwrite bonds. So stocks are the company's equity, and bonds are the company debt. And investment banks have a function of equity sales. And investment banks are involved in mergers and acquisitions. Investment banks provide brokerage services. Investment banks also act as securities dealers and involved in trading securities on behalf of investors, also involved in asset management. So the first function is underwriting stocks and bonds. So what is security underwriting? Security could mean stocks or bonds. So both stocks and bonds are securities. So securities underwriting is the process by which investment banks raise capital from investors on behalf of corporations that are issuing stocks or bonds. Investment banks provides advice on when shares should be issued and at what price shares should be sold. The underwriting process requires investment banks to purchase all the shares at a predetermined price, then resell the shares to market participants. So investment banks need to purchase all the shares issued by the issuer. And investment banks make profits from the price difference. What price difference? So this price difference is also called the underwriting spread. That is the difference between the price investment banks pay the issuing company and the price the securities sold to investors. So that is the underwriting spread, and this is the profit of investment banks. Investment banks differ from consulting firms because investment banks bring money in addition to consulting, because investment banks have to purchase all the shares. If investment banks can find enough investors who would like to subscribe to the shares, investment banks will have to hold. Investment banks can sell all the shares, but investment banks cannot find enough investors. In this case, investment banks have to hold some shares that are not sold to investors. That means investment banks have to bear the underwriting risk. And in addition, investment banks are also actively involved in IPO process and seasoned equity issuance. What is IPO? IPO is short for the initial public offering. That is the first time a private company goes public and lists its shares on a stock exchange. Seasoned equity issuance is an issue of additional shares by a public company who already went public and traded its shares in a stock exchange. So the additional shares issue is called seasoned equity issuance. Underwriters also help the issuers to prepare legal documents. One of such documents is the IPO prospectus. So this graph shows the prospectus of Facebook. This is the IPO prospectus. So what is a prospectus? IPO prospectus. An IPO prospectus is a key marketing and legal document that the company uses to market its shares to the public. So the prospectus includes all the material information about the company and the IPO process. For instance, the prospectus could list all the opportunities, risks, and financial details about the company that is selling stock to the public. Such information is especially important for investors because before a company goes public, most of its information, such as financial accounts, may be not publicly available. So investors have no information regarding how the company performs. So in the UK, all companies, including both public companies and private companies, need to publish their financial statements. But in the US, financial statements or financial accounts for private companies do not have to be disclosed. So the IPO prospectus can help reduce the information asymmetry between the issuers and public investors. So any questions so far? No? Okay, good. So what is undersubscribed? Undersubscribed is a situation in which the demand for an initial public offering or other offering of securities is less than the number of shares being issued. Oversubscribed is the term for when investors' demand for the shares is greater than the number of shares being issued. So when a new security is oversubscribed, underwriters or others offering the security can adjust the price or offer more shares to accommodate the great demand. Because investment banks bear huge risk if shares are undersubscribed, so a syndicate of investment banks could underwrite the transaction together. So what is a syndicate of investment banks? That is a group of investment banks, a number of investment banks work together to underwrite the securities and share the risk of underwriting. There are two types of underwriting contracts. In the first type of contracts, investment banks sell all the securities on a commission basis, with no guarantee regarding the price the issuing company will receive. So that means no risk for investment banks if the securities are undersubscribed. In the case of firm commitment, the underwriter guarantees the sale of the issued shares at a agreed price. That means if the investment banks cannot sell all the shares to public investors, themselves have to bear the risk if shares are undersubscribed. So that means high risk for the underwriters. Private placement. Private placement is a special type of underwriting. It is distinct from public offering. In private placement, securities are sold to a limited number of investors rather than to the public. A benefit with private placement is that there is no need to register private placement with the Securities and Exchange Commission, so long as certain restrictive requirements are satisfied. So that will save the cost of share issuance, because if a company registers its shares with the SEC, the company has to conform to the high disclosure requirements asked by the SEC. For example, disclosures regarding related transactions, insider trading, and major capital events, and others. So other major transaction or key activity of the company. So buyers of private placements must be large enough to purchase large amounts of securities at one time. So those buyers are usually insurance companies, commercial banks, pension funds, and mutual funds. What is a mutual fund? A mutual fund is a professionally managed investment fund that pools money from many investors to purchase securities. And these investors may be retail or institutional investors. And investment banks also take part in the merger and acquisition process. So mergers occur when two firms combine to form a new company. So the firm acquiring the other is called the acquirer. The firm is being required, which is called the target. In acquisition, one firm acquires ownership of another by buying its shares. So before a bidder makes an offer for another firm, the bidder usually informs the target's board of directors and negotiates with the directors. A friendly takeover is an acquisition which is approved by the target's management. In a hostile takeover, which is not approved by target's management, the acquirer has to go directly to the target's shareholders or fights to replace the target's management to get the acquisition approved. A hostile takeover is usually accomplished by a tender offer. What is a tender offer? In a tender offer, the acquirer seeks to purchase shares from outstanding shareholders of the target company at a premium to the current market price. So that means the acquirer pays a higher than market price to the target's current shareholders to purchase their shares to accomplish the transfer of the ownership of the target. And advice provided by investment banks in this process ranges from strategic recommendations about which targets are worth being acquired to tactical suggestions about what price to offer and how to best structure the deal, for example, like the payment method and the time of payment. And brokerage services. Investment banks also provide brokerage services, such as making market orders and limit orders. Market order means buy or sell the security at the current market price. Limit order means buy orders specify a maximum acceptable price, and sell orders specify a minimum acceptable price. That means there is a limit in the price the shares are traded. Short selling is when investors expect the share price will go down. So investors borrow some shares from a broker and sell the shares as a current market price, and then buy back the shares at a lower price in the future to repay the broker. So short selling often occurs when investors expect the share price to go down. Margin is a collateral that the holder of a financial instrument has to deposit with a broker. Margin credit is loans advanced by a broker to help investors buy securities. Margin credit often exceeds the margin investors originally deposited with the broker. Brokers are intermediaries who trade securities on investors' behalf. By contrast, a market maker is an individual market participant or a member firm of a stock exchange that buys and sells securities in its own account at prices it displays in the exchange's trading system. So market makers help to ensure there is enough trading volume in the market, so trades can be done smoothly in the stock exchange. The profit of market makers is the bid-ask spread. The bid-ask spread is the amount between the ask price the dealer sells the security and the bid price the dealer buys the security. So that is a price difference the broker earns. Risk management is a top priority for investment banks dealing with security. The Dodd-Frank Act of 2010 prohibits investment banks from proprietary trading. Proprietary trading occurs when a trader trades stocks, bonds, currencies, commodities, or their derivatives with its own money, contrary to using depositors' money to make a profit for itself. But why should proprietary trading be prohibited? This is because even though investment banks trade securities with its own money, it cannot isolate the risk from its other services, such as security dealing on behalf of investors. If investment banks failed in its own trading using its own money, that would also put depositors or investors' money at risk as well. So this is why proprietary trading should be prohibited. And asset management. Investment banks also manage assets for pensions, endowments, and wealthy families. This kind of services can provide relatively stable sources of income for investment banks. Asset management usually takes the form of mutual funds or hedge funds. So what is a mutual fund? Mutual funds pool money from many investors and invest in securities like stocks, bonds, money market instruments, and their derivatives. Mutual funds are regulated investment products, are offered to the public and available for daily trading. So compared to hedge funds, mutual funds are usually better monitored by the regulators and securities monitors. Hedge funds are private investments that are only available to certain investors. Hedge funds are known for using higher risk investing strategies. So its primary goal is to achieve higher returns for their investors. And higher risk always comes with higher return. So hedge funds are riskier than mutual funds. And exchange-traded funds track the performance of the underlying index and traded on stock exchanges. Closed-end funds have a fixed number of shares being issued. Its price is determined by the demand and supply in the market for the fund. Leveraged buyout funds. A leveraged buyout is the acquisition of another company using a significant amount of borrowed money to meet the cost of the acquisition. So leveraged buyout fund is to use debt to finance the acquisition. So leveraged buyout fund is often used in merger acquisition process. It is to use debt to finance the merger acquisition. And the leveraged buyout funds are funds created for leveraged buyout purpose. And venture capital funds are investment funds that manage the money of investors who seek private equity stakes in startup companies or in small to medium-sized companies that have strong growth potential. So venture capital funds are funds invested in venture capital. Venture capital means capital in startup companies or high growth companies. The importance of investment banking reputation. So, any questions so far? No? Okay. Good. A key difference between investment banks and ordinary issuers is that investment banks are repeated players in financial markets. So their survival and future income are tied to their reputation. This honesty may increase their short-term profit, but at the cost of losing reputation and future income. So long as the present value of future income exceeds the short-term profit from fraud, investment banks will find defrauding investors is suboptimal. Since bank security performance damages the reputation of the underwriter, reputable investment banks tend to underwrite high-quality issues that pose little risk to their reputation. So investors can infer a positive signal from a reputable underwriter's agreement to underwrite. As a result, the market will pay a better price for the issuer who employs the service of reputable investment banks. So finally, investment banks with good reputation often charge premium fees as a compensation for their investment in reputation. That means issuers have to pay a higher price to investment banks that have good reputations. And the premium fees also serve as an incentive for the continued provision of high-quality intermediation services. This paper examines the relation between investment bank reputation and the price and quality of underwriting services. The price of the underwriting service is measured as a cash compensation to the underwriter as a percentage of the issued amount. Quality is measured by the offering yield on each bond issue. If investors pay a higher price for purchasing the bond, that will reduce the bond yield to investors. So price is negatively related to the bond yield. When investors pay a higher price, that will reduce the yield to investors. Because you raise the initial price, you raise the purchase price for investors. That will reduce the total return to investors. And reputation of investment banks is measured by the bank's market share. Market share reflects the revenue stream at stake. Larger banks have more to lose from a damaged reputation. So what does this paper find? This paper shows reputable underwriters obtain lower yields for their issuers. So reputable underwriters are associated with lower yields. That means investors pay a higher price for purchasing the bonds underwritten by reputable investment banks. Reputable investment banks also charge a premium fee. So what is premium? Premium means higher than market price, higher than industry peers. Premium means higher price. So reputable banks charge higher fees. However, the fee premium is outweighed by the yield reduction. So overall, issuers still gain from the underwriting when reputable banks are hired as the underwriter. So altogether, These findings suggest reputable underwriters offer high-quality services, as proxied by lower bond yields and higher insurer proceeds. Proceeds means the total money raised by the insurer. And reputable underwriters, but reputable underwriters charge premium prices. But altogether, the insurer still make a profit from appointing reputable investment banks. So here is another paper. This paper classifies reputation into two categories: type reputation and behavior reputation. What is type reputation? Type reputation is about whether investment banks have the necessary skills, investment banking skills for underwriting. Behavior reputation is about whether investment banks behave ethically. The main conclusion of this paper is that the final sentence, it is unrealistic to expect a bank with a weak type reputation to be ethical. That indicates banks without necessary skills will not be able to behave properly or serve their clients' best interests. So if you don't have the skills, you won't be able to perform well at the interest of your client. Regulation. So the investment banking regulation. The primary goal of investment banking regulation is to reduce information asymmetry. Information asymmetry will give rise to a alignment problem. Alignment problem happens when one party to a transaction has more information than the other. For example, the seller of a used car knows whether or not his car is a bad sale, also called a lemon. However, the buyer doesn't have the information. The buyer expects the transaction would involve information asymmetry and therefore assumes the seller will sell a lemon. So the buyer will only pay a lemon price. Since the seller can only get a lemon price, the seller will only sell a lemon in the market. So it turns out bad products drive good products out of the market. So this is the lemon problem. Only lemons are left in the market. The objectives of the investment banking regulation is to protect the integrity of the markets, restrict competition to avoid too many failures, and protect the interests of the public investors. The Sarbanes-Oxley Act of 2002 helps combat corporate fraud, improve the reliability of financial reporting, and restore investor confidence. The Sarbanes-Oxley Act created the Public Company Accounting Oversight Board to oversee the accounting industry in the United States. The act banned company loans to executives and gives job protection to whistleblowers. The act also strengthens the independence and financial literacy of the boards of directors. The Dodd-Frank Act of 2010 strengthened and expanded the existing whistleblower program created by the Sarbanes-Oxley Act. In particular, Section Section 618 of the Act imposes restrictions on proprietary trading. And the section does not allow commercial banks to hold private equity or hedge funds. That is to reduce the overall risk of the banking system. So, what is proprietary trading? Proprietary trading occurs when a trader trades securities with its own money. And the new rules in 2013 in Europe prevent banks from paying key employees bonuses that are higher than their annual salaries. This is to curb the risk-taking incentives of investment bankers, risk-taking incentives. There are ways to work around these rules, for example, by using forgivable loans. What is forgivable loan? Forgivable loan is a loan you don't have to pay back. A borrower doesn't have to repay a forgivable loan so long as he can meet conditions attached to the loan agreement set by the lender. An investment banking career. So we will skip those two slides and come to the paper. So an important question is that, are investment bankers made or born? The first perspective argues that investment bankers are born. Non-bankers will quit the market in 5 times, that is, in bear market. But when conditions improve, investment banks are reluctant to hire those who didn't start their careers on Wall Street because they have revealed themselves to be unproductive investment bankers. But when hiring new graduates, investment banks have no method for separating the productive bankers from non-bankers. So after some time of working on Wall Street, the non-bankers are revealed and they are either fired or choose to move to the general sector. So the first perspective argues that bankers end up in banking and non-bankers will quit the investment banking industry, no matter when they enter the market. So therefore, although there would be some correlation between starting in banking and working there subsequently, there is no causal effect of first job on Wall Street on subsequent jobs. So the first perspective argues that investment bankers are born, irrelevant of when they enter the market. The second perspective argues that investment bankers are made. So bankers means, for example, bankers means people with the necessary skills. Non-bankers means those people who don't have the necessary skills for the investment banking industry. Those non-bankers will perform poorly after some period of time. So finally, they will be fired by investment banks, or they will move to the general sector because they didn't perform well. So non-bankers and bankers have the inherent abilities or skills that makes them to become bankers or non-bankers. Okay. So the second perspective argues that investment bankers are made, not born. So investment bankers are made by the financial markets, by the market conditions. So made by the market conditions, not made by their skills. So what market conditions? Those graduates hired under favorable market conditions are initially given high-value tasks and develop more valuable human capital that persists throughout their careers. So in graduates hired in good market conditions, in bull market, will develop the necessary skills that make them to become the banker, not their inherent ability. So they develop their skills in the job. The investment banking specific human capital would lead those graduates who go to Wall Street to be relatively productive and would lead to a causal link between starting a career on Wall Street and working there later on. So this perspective argues that investment bankers are made by the market conditions when they enter the market. So over time, they develop the necessary skills that equip them to become the bankers. They are not born with the necessary skills. So what does this paper conclude? This paper shows investment bankers are made by the stock market conditions. Market conditions have a large effect on whether graduates go directly to investment banking upon graduation. A person who graduates in a bull market and goes to work in investment banking industry upon graduation earns an additional 1.5 to 5 million relative to what that the same person would have earned if he had graduated during a bear market and had started his career in some other industry. So if a person graduates in a good market time, it is more likely the person will become the banker and earn more money during his entire professional career. And the compensation premium for investment bankers appears to compensate for the hours, risk, travel, and other factors that go with working on Wall Street. This is not a skill premium. So the high compensation is reward for the longer working time, the higher risk of investment banking careers, not a reward for the skill. And a main takeaway for us is that young professionals or students hoping for careers in finance should get into the industry as early as possible. So let's see, we have 10 minutes left. So here is another paper. A main finding from this paper is that investment banks are generally overpaid relative to other industries. And this overpayment cannot be eliminated by competition. Also, the overpayment is insensitive to aggregate shocks such as financial crises. Negative aggregate shocks, such as financial crises, are absorbed largely by reductions in hiring rather than firing experienced investment bankers. So the last topic is investment banking trends and challenges. So nowadays, investment banking industry trends towards revenue diversification. Investment banks no longer deal with a single service. Some investment banks provide multiple investment banking services, and other investment banks enter the commercial banking sector. To manage its risk, some investment banks sell off some risky assets to maintain a healthy capital ratio, that is, to reduce the debt to equity ratio. And globalization becomes a trend in investment banking industry. US banks pursue a globalization strategy, selling securities to international investors. Foreign banks are expanding investment banking capabilities to the US market. Investment banks also start to use new technology that enables high-speed, high-frequency trading and fast, accurate analysis. Investment banks place emphasis on risk management and back office operation model. What is back office operations? So back office is the portion of a company that functions to support the front office. So investment banks start to separate the back office from the front desk. So here are the two papers we mentioned. The other ones are for your self-reading if you are interested. They are not the main topics of this lecture. So do you still have some questions that you would like to ask?
Hi, Professor.
Hi.
I have a question about the hedge fund and mutual funds. Is hedge fund and mutual fund a part of investment bank or is an individual institution?
So I think you're talking two different concepts because some mutual fund and for hedge fund, because commercial banks could also deal with mutual funds. Commercial banks do not deal with hedge fund because some investment banks also have commercial banking charters. That means they can also deal with commercial banking services. So there is no distinct difference. There is no clear distinction between commercial banks and investment banks. Those banks can also deal with hedge funds and mutual funds. Hedge funds and mutual funds are one of their services, but not every commercial bank or not every investment bank has mutual fund or hedge fund services.
Thank you.
Does that answer your question?
Yes, I understand it.
Okay.
Thank you.
So any questions? No? So any questions? So if there's no question, I will end this meeting and see you next week at 10 o'clock Thursday.
Sorry to interrupt you. I
Okay.
just wrote you to the chat. There some specific chapter for this topic that we covered today?
Yes. So let's have. So you mean refer to your main textbook, right?
Right.
Ah, about the book. For this chapter, I would recommend you to go to part 1, Introduction, chapter 4, Financial Services, Securities Firm, and Investment Banks. And chapter 5 is about mutual fund and hedge fund companies. So if you have an interest to know more about the differences between mutual funds and hedge funds, you could have a look at lecture 5. Sorry, chapter 5.
Okay, thank you very much.
Okay, any other questions? No? So if there is no question, I will end this meeting and see you next week.